Investing activities. As far as investing activities are concerned, we'd say that CFI, or cash flow from investment, are calculated by examining the change in gross asset accounts that resulted from investing activities. Basically, what we are saying is that we need to see how much money we spent on our fixed assets minus so this is actually the money out. So money that goes out on fixed assets versus money that comes in on fixed assets and other investments. So that's our CFI. And the two major sorts of questions that you will get on this, one has to do with figuring out how much cash you paid for assets in a given year, and the other has to do with how much cash you received from selling assets over a year. So to determine how much cash you paid for an asset, it is necessary to analyze whether old assets were sold or not. So let us first take a simple scenario where an old asset was not sold. So if in that case, let's say your ending gross asset value is 10. By gross we mean the total value of an asset without depreciation taken out. So if your ending gross asset value is 10, and let's say initially that we assume that nothing was sold over the year, and your beginning gross asset value, let's say, is 6. So in this simple example, if you started with 6 in terms of gross asset value, ended with 10, then the value of assets purchased during the year must have been 4. So 10 minus 6 is 4. Now let's assume that we actually sold assets with a gross value of 2. So if we sold assets with a gross value of 2 and we started with 6, ended with 10, then what was the cash paid for new assets? In this case, then the cash paid for new assets would actually be 6. How do we get that? Basically by using this simple equation. So we now say that ending value is 10 plus 2, which is how much so this is how much we sold. So we sold off 2. Had we not sold off this 2, we would have had 12 at the end of the year. And then you minus the value at the beginning, 6. So 10 plus 2, 12, minus 6 gives us 6. So essentially, to figure out how much cash you pay for a new asset, you need to learn this relationship. Cash paid for new asset is equal to ending gross assets plus gross cost of assets sold minus beginning gross assets. To determine the cash inflow from the sale of equipment, the equipment accumulated depreciation account and gain or loss on the sale of equipment must be analyzed. So here is another relationship to learn. So cash that you generate from the sale of an equipment is equal to historical cost. So this is how much you originally paid for your asset, or this would also often be the gross value of the asset that you sold. Typically the historical cost is the value at which you initially record your asset on the balance sheet. So let's say that that is 20 million minus this is actually the accumulated depreciation. So let's say that over the years you have accumulated 15 million depreciation on this asset. So your book value for the asset when you sell it in this particular instance is 5 million. You would derive these numbers from the balance sheet. And then to this book value, so book value is the value at which it is shown on the balance sheet. Historical cost less accumulated depreciation. So to the book value you add the gain on sale. So let's say that you made a gain of 1 million. So what this means is that the cash from sale of asset is 6 million. Since 5 million is the book value that we calculated from the balance sheet, from the income statement we can see that the gain is 1 million. So this means that we must have sold the asset for 6 million. had we made a $1 million loss, that would have shown up in the income statement, and we would then say that the cash from sale is 5 million minus 1 million, which is 4 million. This is probably one of the harder questions you could possibly get on the exam, but if you do, let's just be prepared for it. So we'll be calculating the cash received from sale of equipment. So as we just said, the cash from sale of equipment, we basically do the historical cost minus accumulated depreciation. This is the book value, and from this we add the gain. So this comes from the income statement, and this we derive from the balance sheet. So let's do this one step at a time. First, we are looking at the historical cost. So to determine the historical cost, we do this. We look at the beginning balance of the equipment from the balance sheet. So how much is the equipment worth? And this, let's say we are doing this for 2010. So at the start of the year, we look at how much equipment we have, plus equipment purchased during the year. Typically this will be in the footnotes. So let's say that your beginning balance is 10, and then during the year you have purchased equipment worth 2, and then ending balance of equipment, let's say, is 5. So the historical cost of equipment sold then would be 10 plus 2, which is 12, minus 5, which is 7. So this will give us the historical cost of equipment sold. We then calculate the accumulated depreciation on this equipment sold. Remember, this 7 is the gross value or the historical cost. This does not include any accumulated depreciation. So far this 7 represents the historical cost. Now we need to calculate the accumulated depreciation. So to do this, we look at the beginning balance of the accumulated depreciation. So let's say that this is 5 plus any depreciation expense. Let's say that the depreciation expense is 1 in our case, minus the ending balance of the accumulated depreciation. So let's say that the ending balance is 4. So then how do we do this? So 5 plus 1 is 6, minus 4 gives us 2. So accumulated depreciation on the equipment sold is 2. This means that our book value is 7 minus 2, which is 5. And then the cash received from sale of equipment is the historical cost, which is 7 less accumulated depreciation, which is 2, and any gain or loss on sale of equipment. Let's say that the gain is 1. So 7 minus 2 is 5, plus 1 is 6. So cash received from sale of equipment is 6 million. Financing activities. So we have talked about CFO, we have talked about CFI. Now let's talk about financing activities. CFF financing activities are determined by measuring the cash flow between the firm and the suppliers of capital. Remember, broadly speaking, there are two types of suppliers, either equity suppliers or debt suppliers. Cash flow between firm and its shareholders occurs when equity is issued, shares are repurchased, or dividends are repaid. So essentially, CFF is the sum of net cash flow from creditors. So these are the people or organization from whom the company is borrowing money. So the net cash flow is equal to any new borrowings minus any principal amount repaid. So this is the net cash flow from creditors, and the net cash flow from shareholders is the new equity issued minus any shares repurchased. When shares are repurchased, this is a treasury stock operation where cash is paid out, minus cash dividends paid. So this is the cash paid out. Alright, so let's take a slight breather here. what we have done so far is talked about the direct cash flow statement. So we talked about the CFO in the context of the direct cash flow statement, then we talked about CFI, and we just finished talking about CFF. Now that we are talking about the indirect cash flow statement, the only difference is that CFO is calculated differently. We will come up with the same number for CFO that we saw before, but so CFO is different. CFI and CFF look exactly the same on the indirect cash flow statement, so we don't need to talk about these two components anymore. Since CFO is calculated in a different way, we need to understand how it is calculated. And the steps are as follows. Net income is converted to operating cash flow by making adjustments for transactions that affect net income but are not cash transactions. And this would include any non-cash expenses such as depreciation and amortization, any non-operating items such as gains and losses, any changes in balance sheet accounts resulting from accrual accounting. So I'm going to show you an example of this. And under the indirect method, the starting point is net income, whereas as you saw earlier in the direct method, the starting point was cash received from customers. Starting point is net income. Let's say that net income is 100 million. Now we need to make adjustments to reconcile net income to cash flow provided by operating activities. So these are just some examples. Depreciation and amortization. Say you have depreciation and amortization worth 10 million. So you need to add back 10 million. Why is this? Because 10 million depreciation is a non-cash item, and we had subtracted that 10 million in order to come up with the net income of 100. So we need to add back 10 million. Then let me pick on some easy ones here. So that is this non-cash item. So not shown explicitly over here, but let's say that you have a gain in sale of assets. So if there was a gain in sale of assets, then that would have also been included in the net income. So you actually subtract any gain on sale, because this gain on sale is not considered an operating cash flow. That will be considered in investing cash flow. And like you've learned before, if there's an increase in accounts receivable, that needs to be adjusted. So increase in accounts receivable would mean that actually that's been is a use of cash. So any increase in accounts receivable would be subtracted. So any increase in assets such as accounts receivable, inventory, prepaid expenses, increases over here are subtracted, whereas increases in liabilities are added. And obviously the opposite also holds true. So if a liability goes down, then we subtract. If an asset goes down, then we add. And at the end of all this, once we start with our net income, make adjustments for depreciation and amortization, make adjustments for gain on sale of assets, and then make adjustments for assets and liabilities, we then end up with our operating cash flow. And this number should be exactly the same whether we use the indirect method or the direct method. It's just that the presentation method is different. So what are pros and cons of each method? With the direct method, we basically present the firm's cash receipts and payments. There is more information than the indirect method, as receipts and payments helps us estimate future operating cash flows. The indirect method focuses on the differences in net income and operating cash flows. And as you might imagine, since the direct method is more intuitive, the CFA Institute advocates the direct method. As an analyst, how do you evaluate sources and uses of cash? In general terms, you need to be looking at the cash flow in the context of the stage that the company is in its life cycle. So if a company is a startup, then what you would probably expect is cash flow from financing will be positive, cash flow from investing will be negative, and CFO will be very small, most probably negative. You also should look at major sources and uses of cash flow. So if you simply look at something like cash flow beginning balance is 1 million, cash flow end balance is 1.5 million, this does not tell you much. But as you start looking at, say, CFO is plus 6 million, CFI is minus 5 million, and let's say that CFF is minus 0.5 million, this tells you a much better picture. So even though we'll come back to the fact that based on this information the net increase in cash was plus 0.5 million, which is what you could see simply by looking at the cash information, beginning balance and ending balance, but the cash flow statement allows you to see where the money is coming. So this is a good picture because it's showing you that most of the money is coming in from the core operation of the company, which is being heavily invested, plus the company is also paying off some of its investors. So this cash flow statement tells us much more than simply looking at the changes in the cash balance. And then beyond this, you can get into more details. With the cash flow statement, we can also see whether the cash flow covers our basic capital expenditures, which in my simple example we see that it does. We see that enough cash is being generated to cover our capital expenditures. As you dig into the specific segments of the cash flow statement, if you look at the operating cash flow, as an analyst you need to look at over years how is net income changing versus cash flow. So if you look at a situation where net income is going up but your cash flow is going down slightly, this is clearly a cause for concern, because in the long run these need to move together. So the situation that we have here is the company is probably recognizing revenue too aggressively or not recognizing enough expenses, which would explain a diversion. You also need to look at the major determinants of cash flow. Are you generating cash because you are getting more money from customers, or are you generating cash because you are not paying your suppliers? And then you should also look over the years at the consistency of cash flow. So do you have a consistent cash flow that's going up, or do you have a very erratic cash flow which will indicate a higher level of riskiness? Investing cash flow, there you need to see how is the money being invested, and if you are getting some money through CFI, where is the money coming from? If lots of assets are being sold and cash is being generated through sale of assets, then that would be a cause for concern. And then financing cash flow, we've talked about. This shows how much money is being raised through debt, through equity, and then how much money is being paid back. I would encourage you to study example 8 on page 281 of the curriculum. This covers this topic in a fair amount of ratio analysis, common sized analysis for the cash flow statement. Just a few basic comments here. Cash flow statement can be converted to a common sized format by expressing each line item as a percentage of revenue. You can also do the following. So you can take the cash inflow of cash can be expressed as a percentage of total cash inflows, and cash outflow can be expressed as a percentage of total cash outflows. So for example, your total cash outflow might be 170 million, and then this ratio over here will tell you how much of that cash in percentage terms is coming from customers and how much is coming from other sources. Ideally, you want a situation where most of your inflow is coming from customers, and obviously cash outflow expressed as a percentage of total cash outflows, this gives you the relative importance of the different types of cash flows. So unlike the balance sheet and income statement, where there is essentially one way of creating the common sized income statement and one way of creating the common sized balance sheet, with the cash flow statement there are a couple of different ways, and a diligent analyst will use both possible ways to get as many insights as possible. And the sorts of insights that you can get would basically, with a common sized analysis, you can look at trends in cash flows, and it can help you forecast future cash flows. As I mentioned earlier, for equity analysts, free cash flow calculations are extremely important. So free cash flow is a measure of cash that is available for discretionary purposes. It is available once the firm has covered its capital expenditures. It is a fundamental cash flow measure and often used for valuation. There are two major measures of free cash flow to firm, free cash flow to equity. And I'll just comment at this point that this, according to the CFA Institute, these are the two major measures that you need to learn, but different textbooks and different companies might use additional or other definitions. For now though, let's just learn these two. Free cash flow to firm, when we say firm, we need to take the perspective of both debt holders as well as equity holders. So both debt holders and equity holders are considered investors. So free cash flow to firm means the total cash flow that is available to all the investors. So that's this entire group. And the definition of free cash flow to firm, which you need to memorize, is that it is equal to the cash flow for operations plus the interest into 1 minus tax rate minus the fixed capital investment. And notice that since this is money available to debt holders also, if we are using US GAAP, for example, interest is subtracted when we come up with CFO, and that needs to be added back because we are taking the perspective of equity holders and debt holders. And CFO can be expanded, as you just saw with the indirect statement. You can calculate CFO by saying net income plus non-cash charges like depreciation minus working capital investment. So that's what CFO is equal to. So the above formula can be rewritten like this. And if you are using IFRS, where you have not included interest as a part of CFO, then it is not necessary to make the adjustment for interest. Free cash flow to equity holders, and the formula for this is free cash flow for equity holders is equal to CFO minus the fixed capital investments plus net borrowing. A positive free cash flow to equity means that excess operating cash flow over the amount needed for investment and repayment of debt. Now let's briefly talk about some ratios. These are just ratios that need to be memorized, and then you'll see these in a little more detail in the next chapter. But cash flow statements can be analyzed by comparing the cash flows either over time, which would be time series analysis, or to those of other firms, which would be a cross-sectional analysis. Broadly speaking, you can categorize ratios as performance ratios and as coverage ratios. So with performance ratios, you basically are determining the performance of a company, and there will be analogies to cash flow oriented performance ratios. So you'll find analogous ratios in the income statement. So cash flow to revenue, this is simply the total cash flow generated through operations divided by net revenue. Cash flow to asset ratio. So I would actually encourage you to pause over here and simply memorize these performance ratios. And these are coverage ratios, where again I would encourage you to pause and memorize these ratios. The general principle here though is that with this interest coverage ratio, you will see an analogous ratio when you look at the income statement. So the analogous one is EBIT, which is your operating profit divided by the interest expense. So essentially what we are saying here is that this is essentially equal to our cash flow that is generated. So we want this number to be high. So we want the numerator to be high, which is the amount of money that we generate, divided by the interest that we pay. We would want this number to be low. So this, if this interest coverage ratio is high through a high numerator and a low denominator, that is a good sign. That means we have a lot of coverage, and as a bank, if you are lending money to a company, this is a ratio that you would pay a lot of attention to, where you would be happy lending money to a firm where a lot of cash flow is generated and where the interest that company is currently paying is low. So I would emphasize this ratio.